What's up, Sherpa Network? Thank you for tuning in today. My name is Jonathan Tenenbaum, aka JT, aka J On, aka Sherpa Winfrey, and I'm the host and producer of DomainSherpa, where all roads lead to domains. Today's show is part of our Down the Rabbit Hole series, as we say in DomainSherpa. All roads lead to domains, and in the reverse, our work with domains has us venturing all the time into different areas and topics, some domain related, some not so domain related, hence the jump down the rabbit hole. Today is actually super cool. We've got the one and only Rob Schutz from Snag.com to talk about his company, his journey, all that good stuff in the domain space and otherwise. But I'm going to wait to get to that. I'm going to introduce him with all his AKAs. But first, let me go ahead and introduce to my right, we got my boy Andrew Rosner, aka Morpheus, aka the Dirk Diggler of digital assets, aka Bob Lee Swagger the Sniper, aka Drew. Drew got what I need, aka Every Rosner has its thorn, aka Never Gonna Give Drew Up. Get Rick rolled, Graybeard, the domain pirate in the building. What's up, dude? How are you?
Exhausted after all that, but yeah, good. I'm good. Just returned from a little trip in England. Very pleasantly surprised. I went with low expectations, and I gotta say, I kind of forgot how beautiful London is and what a great city that is. And I'm gonna just straight up say, London is like everything is great about New York without the bullshit. So I really enjoyed it, really did. And I'm a New York lover. I love New York. I'll be in New York in the summer, but like it's a lot of baggage. You know what I'm saying? There's a lot of baggage with New York these days. And London was like great. It was just great. Although you eat way better. You really just don't eat that well in London. Except Indian food. But great Indian food. But other than that,
a lot of hot takes.
You got fish and chips and Indian food. That's all I'm gonna give you. And then good beer. The pub culture, amazing. 10 out of 10. Like amazing, on point. Yeah.
Sounds like
a great time.
Nice little time.
Oh, all right. Let's go ahead and introduce the special guest down below me, kind of to my right, sort of, but down. We got the one and only Rob Schutz, aka Rob Report, aka Rob Roy, aka Snaggletooth, aka Snag Get the Bag, aka Rob Shuts the Front Door, aka Rob's a Bad Mother, Shut Your Mouth.
Oh my God, JT, this is my favorite part of the show, the AKAs. You crushed it. Well, thank you for having me. Thank you for all those names. I'm gonna write them all down and send them to my mom. But yeah, thank you guys for having me. Long time listener, first time participant here. So
yeah. Dude, I'm super happy to have you on the show. For the folks who don't know, Rob's the co-founder of Ro.co, and also the co-founder and CEO of Snag.com, among a bunch of other things. Go check out Snag.com if you have not. He's kind of come onto the domain scene and really sort of established himself pretty quickly, very effectively, doing some big things. We've done some deals together. I've seen, you did an AMA with the ICA. You were at the ICA annual meeting. Are you going to be at NamesCon as well? Or are you going to be doing your thing at NamesCon?
I'm trying to navigate. I bought tickets for myself and Brian, my business partner. And then my wife was like, by the way, because I put on our shared calendar, she was like, by the way, the kids have off that week. I think we're going on a trip. And I was like, how about Miami? So we're going to see how that shakes out. My plan is to be there. But negotiations sometimes easier on the domain side than it is on the home side. So we'll see how it goes.
Sometimes, I mean, almost like every time, man. You know what I'm saying? You're talking about that's the ultimate deal right there when you're working out the stuff on the home front. And the shared calendar is do you guys we picked up one of those Hearth calendars. I don't know if you've seen.
Oh yeah, I know that team. I mean,
What's
people
that?
love that. It's like one of the on the wall kind of digital calendar where you can
like a physical thing.
Yes. Yeah. Well, it ties to an app and everything, but there's a physical version that sits like kind of in our little butler pantry area that, and you can go and see visually like, all right, what's everybody got today, broken down by family member, all that kind of stuff. And then it's also on all of our devices.
Do you maintain it or do you have the butler maintain it?
Exactly. It's my wife maintains it, so she would
I see. The butler just doesn't into different areas.
It's just a little extra sort of side room in the bar,
No, I have to give you shit about it, of course. And I assume you get your food via dumbwaiter as well.
Exactly.
It's
got it. Don't
website. back in the day when those were a thing. We launched the same week as Living Social and like Groupon. It was like got really hot in the domain space. But it was just me with some
We
money
sold
from
domains
my
to all those
parents.
guys. We sold.
I'm sure.
I'm pretty sure we got rmn.com for Retail Me Not, and we got we sold some big name to Groupon.
Yeah, they're still sitting on a bunch
I
of
think we
good
sold
names.
like online coupons and coupons online or something to coupons.com. It was all around that little period of time. At that time, I launched this like affiliate daily deal site. I had just acquired dx.com, and I was like, all right, I got to do something with this. I don't want this name just sit there. And so I launched Deal Exchange on dx.com, and basically we just consolidated 71 different domain daily deal sites, all the offerings into one place, one email every day. You could select the different categories you're interested in, so you'd only hit
Nice.
deals that were interested to you. And I don't know. I don't even know if I think it made a little money, and then we ended up selling the domain to some giant. It was like the Hong Kong. What was it called? Deal Extreme, and it was like nobody in America had ever heard of them, but I'd never heard of them. But they were like bigger than Amazon at the time, and they were like the biggest.
And they had money.
Oh yeah. So we had sold that to dx.com. Then they went bankrupt a couple years ago, and I bought the name back for just a little more than I paid the first time around. Now I got it back.
I mean, these names have a way of coming back home, you know.
That's it. Patience.
So real quick.
Well, so yeah, you're familiar.
So for you, was that kind of? I guess you're pretty entrenched in the startup space, right? You've got a pretty good network. Where did that come from, right? So you know, you're a Penn State guy, post school. You know, what we are, right? Yeah, no doubt.
Yeah,
I mean,
I started. Yeah, shout out Penn State. My whole family's Penn State, by the way. My parents met there. My brother went there. My parents retired to Penn State, so
wow.
Happy
Valley for real, man. Let's go.
Happy Valley all the way. Yeah. So I coming out of school, I wound up doing like healthcare technology consulting for like 5 years. I was just kind of in like the tech and business space, and then that just got really boring. Like we would help hospitals, and the sales cycles were really long, and it was kind of like it got painful. Great job out of school, but I think that pushed me more into like, how do I get into a world where things happen more quickly? And that's when I actually saw the daily deal stuff. I'm like, that's as quick as it can be, right? It's like every day, new deal, and people are
just
buying
shrinking
things
the
online.
cycle. Yeah, we're going to do it. I like it.
And now you swung the other way back to domains where it's these very long sales cycles.
Yeah, you know, I got into like really chasing the dopamine hit of every hour, every minute, like what's going on with traffic and purchases, and like that's what really brought me into like deals. And then after that, I sold that company, and then I wound up I was one of the first employees at a company called BarkBox, which is treats and toys for dogs.
Yeah, I remember that. I remember BarkBox.
They're public. They're doing their stock's not doing as well, but their team's doing very well, and they've launched a whole bunch of shit, including an airline for you and your dog called Bark Air. That's real? It's real, and it's doing extremely well. They launched like New York to Florida. They have New York to London now, so you can go catch up on Indian food. But it's like flying. It's like flying private with your dog. Which you just can't really do. And it's like it's not super cheap, but it's less than flying private, and it's like a fully catered experience. It's like ridiculous. Just check out Park Air on Instagram. It's like wild. Our second kid, we moved to New Jersey. Shout out New Jersey. Bought a house. There's like a lot
of America, baby.
Hey, we'll take it. We just like being in the conversation. And yeah, so wound up kind of debating that. And my wife was like, you should probably do it because you will be very regretful if you do not take this opportunity. And she is smart. And I wound up joining up with the guys, and we launched Row in 2017. And we launched as Roman, just focused on erectile dysfunction. I'm sure you guys got many of our ads, probably still do, which was cool. Like I came from more of the performance background, and like marketing and getting people to come to the site and buy things, but we were very complimentary. My co-founder Zach comes from like the healthcare space. His dad is a really well-known sexual health doctor. He had built companies before, fundraised before, and then Saman had built a couple big businesses. One got bought by WeWork, called Managed by Q, and he was like a real design product tech guy. And so I was like, the opportunity felt good because it was very complimentary. I was like, I don't really know how to do any of that other stuff, but you guys actually have no idea how to do marketing. So it felt like we were three complementary legs on the stool. And I love that we were starting with erectile dysfunction too, because it's like the most popular profitable drug of all time. And it works. And, what was the stat? I'm like pulling from the archives here, but it was like the NFL, I think Viagra and Cialis spent like $250 million just on the NFL ads per year. And I was like, I'm pretty sure if we bring this on the internet, it'll work. I felt good about it working. And so, we kicked that off 2017. We launched like actually the day before Hims launch.
Really?
All these things we were talking about cycles.
Did you know the synchronicities, but did you know that they were in the pipeline?
Yeah, totally. It's all cyclical. Like, we went out, we'd be fundraising, talking with the VCs, and they're like, didn't we talk to you guys? Or we talked to somebody who was doing this? There was three of us. It was Hims, Roman, and Keeps was a hair loss one, all kind of go at the same times. And the way investors like to play this is they want to have a bet in the space, right? And so they're like, hey, if I think online telehealth for hair loss, erectile dysfunction, whatever, if I think that's a thing, I'm going to either invest in these guys or these guys or these guys. So
or all of the above.
Usually not all of the above, but usually they'll make a bet. So we launched they launched the day after us, no big deal. And then we just like hit the ground running. Like, I had the playbook of how do you build big scalable marketing campaigns. We were on TV probably 2 or 3 months in, just like cranking. And it was really like, there was a lot of stops and starts early on, but you can tell when there's traction on something or when there's not traction.
100%.
And so we were fortunate. We were able to fundraise, move really quickly there. And then, eventually expanded into other products. We had a smoking cessation product called Zero. We had a menopause product called Rory. So they all kind of had row in them. That was like thoughtful. And then over time, as we built out dermatology and weight management, all these other areas, it was time to move away from like Roman, which we'd spent like $250 million pounding into people's heads about erectile dysfunction, to move on to something a little bit broader. But wild ride. And throughout the course of all this, like one of my many things was like, I want to get the brand tight. I want to get the domains. I want to get the social handles. And that would always kind of be like a side project I did. And then other friends in the space or investors would be like, you're a nerd about this stuff. Like, somebody asked me about a domain the other, like, how do we even do this? Or like, how do we get a social handle? And so people just kind of naturally come to me because there's not a lot of people that are like experts in this. There's not a lot of people, as you guys know, that are like experts in this stuff in general, but especially in that space. And so people just come to me and they're like, why am I like WhatsApping with some dude in the United Arab Emirates at 2 a.m. to try and get this domain name? They'd be like, oh, it's this guy. I know this guy. Like, I've worked with him before. So that was always just kind of like a weird obsession. And then as we grew, I stepped back after about 6 years. All great experiences. Was really, really happy with how everything went. But part of the byproduct of the company growing, doing well, is also got big. And your role changes, and like the needs of the company from you, and that role changes. And kind of felt like, while there's never a good time to do anything, it might not be a bad time to take a breath, see my family a little bit, try and pick up some hobbies, and figure out something potentially new. And so, that was like a little over 2 years ago now. And one of the things I just naturally gravitate back to is always like the domain name stuff. People continue to reach out and they're like, how do I do this shit? And I'm like, actually kind of like this. Like, this is pretty fun. And you guys know, like, you get a real rush of exhilaration getting these deals done for people.
Totally.
And especially the really gnarly, complicated ones too, that are like, we've been trying to get this for 3 years. No one will fucking respond to me, whatever. Like, even if not for a lot of money, it feels pretty good. We're like, I got a tough thing done. I like being the guy to get tough things done.
Yeah.
So anyways, exact match of like, why would I not have it? Other people do not, and they prioritize differently. Like, both are reasonable strategies. I think it's just always interesting hearing from people who I feel like maybe haven't built as much, or understand like what goes into scalable, profitable growth, etc., and like how domains play into that. It's all different parts of the spectrum, but that's just been
it also depends
interesting.
on the type of business, right? In some businesses, they're 100% right. In some businesses, if you are a, well, Row is a perfect example. If you are a direct consumer company, your brand needs to match your domain, and your domain matters. And so, there are instances which.
I've been working on Row.com for about 8 years, by the way.
Yeah.
If you see it pop up, you let me know.
Well, I mean, I could have gotten it for you for a great price 8 years ago, for 6 years ago. It was
someone
owned by
sent me a screenshot.
It was owned by a very good friend of mine, and but he since sold it, and now it's harder. So,
it's owned by a massive Asian gaming company that's worth $50 billion, and they built a huge franchise around Row. So I talked to them. I emailed with them yesterday. They know I'm first in line, but I think it's one of those too, where like, I've had some people kind of come at me for that too. They're like, "What a fucking idiot! How do you not have this asset?" I'm like, "I want it, but it's not always something you can get, and it's also like not the end all be all. We will be fine, but it's one of those."
So interesting point though that I've observed, because for a long time I was doing a fair amount of angel investing. I probably invested in around 40 something companies, and probably closer to 50. And one of the things that I've noticed is that the folks that, I think what you've just said is very important. So it's not always the case that you can get your name. It may just be unobtainable because of the price or because of its use. But the founders that do make a concerted effort, they actually allocate the time, the resources, the mind share to say, we're going to try to get this, and make a concerted effort to do so at their seed round, A round, or B round latest. What we've observed is that it's roughly the Pareto principle. There's roughly an 80% chance that at a 5 years out, they survive. And the ones that don't, that say, I don't care, I'm not going to spend money, waste money, I'm not going to do it, they have a roughly, it was slightly less than 80%, I think it was around 74%, have a failure rate. At 5 years out, they don't exist. Regardless of the reason, they don't exist. And I made that observation quite a while ago, which is one of the things that triggered me to start making investments, because I thought, oh, that's an interesting signal. And it's a signal that is, I don't think anybody else has ever used. So I think it's, interesting and could provide alpha. So anyways, over time of observing that, what I've concluded is that what it indicates, what it's a proxy for, is long-term vision versus short-term vision. Indicates what it's a proxy for is long-term vision versus short-term vision. And so a lot of companies, I would say the majority of companies, are building a company to be sold to another company. That's the objective. From day one, they see a space which is consolidating, or they see a space that has growth where they know that the main players in that space, in order to continue their growth, are going to have to do it through consolidation and acquisitions, mergers, etc. And so they're building companies to sell to companies. Amazon is has been super acquisitive for 20 years. Probably some meaningful percentage of all startups out of Silicon Valley or Seattle were ultimately just sold to Amazon, and the founders knew that was the goal. It was like, build a company, 3 years out, 5 years out, sell to Amazon, repeat, rinse, repeat. And
Yeah.
those people didn't need to go get their domain, at least in their mind, because they were building for the exit. Whereas the founders that are looking to build a company and build a brand, those are the real unicorns. Those are those are the companies that go on to be, you know, household names. And the difference is founders understood that early in the game. That's what they were building for. And in order to build that, they did need their domain. And so again, they don't always necessarily get it, but they made a concerted effort to try.
Yeah. And a lot of it though is timing, right? Like I'll talk
It's all
to
timing. This whole business is timing.
Totally. But I mean, even from the startup's perspective, like I'll talk to do a lot of work with Y Combinator companies, and they're just getting going and they're figuring out branding. And like sometimes they want to go buy the $1 million name.
Mhm.
And I'll have the conversation with them about like, can you afford that? Right. Like, does that make a meaningful impact on your business now? Because it's like great if you're trying to go build a big company, you're trying to go public or whatever, but like you have to make it. You have to like get there and not run out of money. That's kind of the whole
Yes.
game. Don't run out of
Yes.
money. So like if you think it's truly additive and you know it's worth spending on that versus hiring 4 engineers, you should do it. But also it could be something you earn the right into over time where you say like, let's go make sure the product works. Let's go make sure people actually want to pay us for our product and services and we actually have fit and we have like margins. And then we go raise the A and then we go get it. Might not be there. Of course, there's timing as we talked about, but we talked a lot about that at Row in general, which is just like earning the right to get to the next level of the game. And sometimes you want to start early and make some of these investments early because you have confidence in cash and et cetera. And sometimes it's like find something good enough. Like we were on GetRoman.com, for example, for many years. And that was like fine. It wasn't great. But it was fine. And then once you get to the next level of like, hey, we've raised more funding or like we have good enough profit margins or cash flow where we can go invest in stuff, you can go acquire some of these other assets. But timing and when to spend on this stuff, it can be just as important as availability.
It also shows you too, it's what's so interesting about the domain space is that you do have this situation where you've got, you know, these gatekeepers, right? Folks that are sitting on a lot of really valuable domain assets, really valuable brands that, you know, and you've got to sort of navigate some of the personal aspects, right? The relationship piece matters, the communication matters. It's not just simply, you know, sometimes just getting a conversation started. I mean, you realize like, you know, how much that is important to trying to get to a deal. I really think it's super interesting your perspective being somebody who's been involved with, you know, building successful businesses and where the domain sort of falls in the process, right? And like that's going back to this whole idea. And I think maybe we'll even call the show Timing is Everything. It might even end up being the title of the show because, you know, it really, but I think it displays the importance of being on it for the domain like early so that you're at least aware of what the situation is because two things. One, it's like, you know, if the domain changes hands, right, the price changes and then it gets harder to acquire, you know, and then as your business is more successful, especially if you are a public, you know, B2C type of company where, you know, the seller is going to be somewhat more aware of your financial situation as a potential buyer. And the more successful that you are is another thing that's going to drive the price up because this isn't going to happen in a vacuum, right? So it's like as all of a sudden you go and raise money. Now it's like, oh, you got money. Okay, well, the price of a brick just went up, you know, and you know, so I think that's also where the timing piece matters. And you know, and also why it's like you have to be aware again of all right, where are we at with this name when we're ready to go get it? Hey,
is there an upgrade path or 100%.
You know, there's an opportunity.
And you definitely want to, like, if you're starting from scratch, you definitely want to make sure there is an upgrade path. And usually upgrade path is also proxy for like, there isn't a big company already on that, right? Like it's silly to start a company with a name when there's already a really big, well-known brand who's also using that domain name. Like if you get to choose from the jump, pick something else that like is a little bit cleaner, even from just like a branded and organic search perspective. Like you have one hand tied behind your back if you're starting there. But yeah, it's always good to know, like, hey, we might start with a prefix or a secondary TLD or whatever. But like, it's good to know, hey, that one's out there. It's gettable. It's I'll usually run down pricing on the upgrade as well because it's good for people to know, like, hey, I'm going to go in for a B. Should I try and tack on a little bit more cash, take slightly more dilution, and go out and get this asset versus just like maybe it's gettable, maybe it's not. Maybe I assume it's 100K but it's actually $2 million. Like the information is very valuable to know at that point too.
We have seen this with like, oh, metaverse is the new internet. And so now everybody is going to go put meta or metaverse in their company name in order to go raise capital. That was 4 years ago. You can go look 4 years ago. That was exactly what was going on. And that's all that's going on here because VCs have a thesis. Their thesis right now is AI, 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 AI. And so if they're not, convinced that you're really an AI company, when your prospectus hits the desk, that's it. They move on. So
yeah.
It's just being AI forward. That's all this is. And in 18 months, when these guys are realizing that 80% of their AI investments are going to zero, they'll move on and they'll, look, I don't wish poorly on anybody with .ai domain. The whole reason I've even been vocal about this was just literally because I don't want people investing tens of thousands or hundreds of thousands of dollars into portfolios of domains that they have a very low chance of selling unless they can sell them in the next 12, 18 months.
Yeah, I understand that. I actually think that maybe we were talking about a little on the last show as well, JT, but I think like the increase in activity around AI I do think it only helps the .coms over time. Like it's another company building on that brand. You now have another competitor who wants that name. And I think like it's like perfectly acceptable to have a good one word .ai name. And people start there and then hopefully you get 3 or 4 different companies that have done well in that name. Now you have competition. I mean, certainly there are counter examples, but have had several clients that have the AI that we go out and help them upgrade to the .com. We've had a handful that own the .com and they want to go out and for brand protection go get the AI as well. Yeah. So I do think we're still in this like bit of a frothy mode right now, time period that could last a couple more years. I think it's dependent on the funding and how much keeps getting pumped in. But I do think long term, I agree. I think it's valuable for like the ultimate asset to own for that word. I agree with you. I think it's going to be the .com.
Yeah, I love it. No, good stuff. Well, look, we've only got probably about another 10 minutes. So, let's kind of push it to you now to see if you got anything else you want to talk about as far as anything you want to bring up, promote, or anything. I mean, we always give our guests that opportunity. You don't have to necessarily pick something.
Can I ask one more question while you're thinking about that?
Please.
Sure.
As somebody who really kind of came, from the outside in, what would be like your biggest criticism of the domain industry? And I mean really the domain investor and the aftermarket industry.
Yeah.
And then like, is there a suggestion that you would have? Because I personally, having been in it for quite a long time, not as long as many others, but for quite a long time, I have a whole host of criticisms and, things that I'm truly, I just think are disappointing that we haven't evolved from.
Yeah.
But
yeah, no, I think, look, I think there's one of my biggest, I don't know what you call it, criticisms. One of the things that I'd love to see innovation around, and I don't necessarily know what the suggestion. I hate throwing problems out there and not at least like being part of the solution. But I think something I would love to see more of is so many of these great names are just sitting there, and there's valid reasons why, and there's an incentive structure that allows for it, et cetera. But then I talk to so many of these businesses that are getting up and going and they want to use those names. It would be beneficial for them to use those names, but they're just not there in terms of like stage or money or any of these things. I would it frustrates me, especially having those conversations with the founders, how inaccessible some of that inventory is, because I think everyone wins. Maybe not everyone wins, but it does feel like a win if we can get more of these names into the hands of builders. And I don't yet know what the solution is, because I think, again, the incentive structure, and this all started in like the 90s, and how people pick these up, and in the investment structure, like, it's all very rational and reasonable how things have come to be. But I just hate seeing all of these great names collecting digital dust. And I don't quite know how to marry that. Like, we talked about equity, and I did like a little article on equity this morning that I published, and like, maybe there's something there, but it's also really complicated and it's annoying, and like, people don't want to have their names locked up in a startup that doesn't work. And so I don't know what the solution is, but I think that is one thing that seems like, man, it would be really nice if we could put some of these assets to work, because I think in the end it actually helps the industry more, because
Yeah.
these people are on TV, and they're like,
Yeah.
they're much more active, etc. So that's the one thing that came to mind when you asked that.
Yeah, it needs to be institutionalized. I mean, this has really been one of my big focuses I've been thinking about for a really long time. And, you know, I think that it needs to be institutionalized, because people are looking at these things very myopically, and it needs to be institutionalized so that it's really being turned into a spreadsheet, right? It's like, look, there's 25,000 super premium domain names that are sitting there collecting dust. They're effectively not really earning parking revenue anymore. Like, let's be honest. If you're earning parking revenue, it's not on your best names. It's on your fucking trademark typos, right? And so, you know, the truth is it really requires one of two things, or both. Either, like, it has to be institutionalized in the form of like an internet real estate investment trust, which is sort of what I've been trying to sort of build towards. I don't know that I've got the gas to push it all the way there anymore.
What does that look? What does that look like?
Well, so if you think about a real estate investment trust, right? It's a portfolio of real estate, and there's capital, and so you've got a balance sheet that's got capital. And you got assets, and basically, they then leverage the assets to get more capital to continue to acquire more and more real estate. They also might do lending. They might do bridge funding. They might do, but they'll offer some services, perhaps cash flow services, around the asset class. But primarily, the objective is, you know, kind of like what Michael Saylor is doing with Bitcoin. It's like, do whatever your business can do to create more capital to acquire more of this real estate, right? Whatever class, whether you're a data center REIT, or you're a residential apartment building REIT, or you're a commercial REIT, or you're, you know, whatever it might be. Land REITs is, you know, cell phone tower REITs. There's everything you can imagine. And um, the same thing should exist for domains. And so there ultimately, I think what there will be someday is an internet real estate investment trust, where this thing has accumulated a ton of domains. Its sole objective is to look at it from a cash flow perspective and to grow its balance sheet. And so it would make perfect sense to basically say, okay, here we've got a mechanized process where you just take this, and it's okay, it's $1 million domain name. And so we're going to basically, you know, annualize that at, I don't know.
We'll figure out the
literally,
structure
like,
with you to make
you
it work.
just step right in, put 3 months down, just like you would on a residential apartment, right? And so you step in, and it's, you know, whatever, call it 10 grand a month for easy public math. So you put 30 grand down, you start paying 10 grand a month, and that's it, right? And then you got a buyout option, and then that's it. And so now you got to grow it, and they don't care if it's 24 months, 50, 60 months. All they care about is that they keep turning these names, and people are paying their monthly nut, and then eventually they buy them out, and then they use that capital and they buy more names. Right? And that's ultimately where this is going to be. But
the benefit of doing that structure also, sorry, I was going to say the benefit of doing that structure, which is really smart, is, you know, if I have a portfolio of 10 names that I'm contributing, I'm getting payments. I assume I'm getting payments from the trust, independent if my names are being leveraged or not, right? like you could do it where it's shared, where it's like, hey, you're putting 10 out of the 100 names for easy math, right? So you're getting 10% stake of the payments every month. It doesn't matter if it's my name or somebody else's name or whatever.
Well,
You
that's a
find a
clever
way
way to go about it if you pay people in equity, right? So if basically they contribute to portfolio in exchange for equity, so they've got a smaller piece of a larger pie, and
right. I
then
guess that's they
right,
could
and
do
so
it.
then they're generating cash flow on all of the names through distribution in the portfolio, whether their names are being, leased out or not, right?
Yeah.
And so
There's different
again, it's
flavors.
what
Yeah, different flavors.
institutionalization is all about. It's about spreading risk, spreading reward. You're going to dilute the reward, but you're going to make it much much less volatile and and more smooth, right? And so I think that's probably where we land. But in the meantime, I also think there's an insanely good opportunity with so many compounding benefits for one of like whether it was a YC or an A16Z, but one of the like let's say 5 biggest VCs. And I pitched this to A16Z about I don't even know 8 or 10 years ago. And I said, guys, look, this was the perfect time too because parking was basically dead.
Yeah.
The market had just gone through, the whole financial crisis, and so people were ready to sell for cheap prices. And no, they just said, just it wasn't part of the model. But like, imagine you're one of those VCs, and you go out and you spend, I don't know, $100 million, and you buy up, let's say, a bunch of the
Good load
best
of premium
domains in the
inventory. Yeah.
world that you can literally just start putting to work in your operating businesses on a lease with a convertible, option. You got
Yeah.
convertible debt. You got the best place on the cap table. If the
Yeah.
guy goes out of business, you just claw the name back, rinse and repeat. You got a stable full of these assets, and you're just basically kicking out. Starting like 15 years ago, people were like, I mean, every person you got on the phone with was like, the person that owns the person that owns my domain name is a squatter. I don't want to pay them a dime. I'll pay you whatever your fee is. I don't even care what your fee is, but I won't pay the son of a bitch that's got my domain name anything. Right. And today it's a lot different conversation.
Yeah, well,
Yeah.
I think what we've seen too is, I think the appreciation, kind of to your point, Drew, about on founders, businesses, and brands. The sort of the general thought about domain names and the value of domains is a lot more prevalent. It's more people understand more about domains and the fact that they have value, how it works. We mentioned it, and I've referenced this a lot. Drew brought it up on the Tim Ferriss podcast. About second time, third time founders, having been through the process, having a much better idea of the domain name landscape and the value of domains. And, and I think that, also, there's a lot more information available, whether it's through ChatGPT or just the internet or whatever. Like, people just understand the domain name landscape, brands understand it, VCs, founders, PE firms understand it. The domains are valuable assets, right? And that it's not as shady on that front, right? Which then I think adds more transparency and legitimacy even on the selling side, right? Because the investment side is now more tightened up. And I think, Rob, to your point, the more that you instill trust in the marketplace, right, and across the board, I think it's knowledge, understanding, trust. All those things elevate the entire space, and we're at a point where .com, valuable .com domains are worth more than they've ever been, because that understanding is out there. And I think, and you have some maturity and evolution in the market, but it's still a very niche, small space. So it's like a person like you can come in and make a difference kind of quickly, make a mark, because, sometimes common sense is not that common. A little bit of brains, a little bit of common sense, a little bit of personality goes a long way. And I think all that plays into
Are you implying that Rob's only got a little bit of each of those?
I mean,
You can take that, by the way. I'm fine with that. That's high price.
but
Yeah,
I
and
think
JT,
so.
maybe just to put a bow on it, like I think obviously things have come a long way and are in a much different spot than they were 10, 15 years ago. I still think there's plenty of education left to do in the buyer startup world around what these things cost. I feel like 20% of my conversations when someone comes in, they want a super premium name, and then I'll give them high level pricing, and they're shocked, right? And I'm like, hey man, I don't set the prices. I'm trying to help you understand like market. I think there are ways we try to do that a little bit with content and interviews and like things like that. But I do think there's an opportunity to help folks understand not just the value, but even just overall what these things go for, right? Like what are investors buying these things for versus what are they then intending to turn around and resell it for? There's a not insignificant portion of very smart, very talented, very well-connected founders that are still shocked at these numbers.
Yeah.
So I think that's an opportunity here too, is to like just educate as well.